Hello, Strathaven Middle School. My name is Saj Moradi. I'm going to spend a few minutes talking to you about my career in finance as a portfolio manager, which basically means I invest in a bunch of different companies with a team, and we build portfolios, basically called mutual funds, for either individuals to try to grow their money in, or for schools, hospitals, other organizations to put money, whether it's retirement money or other assets in, with the goal of trying to grow that for them to be, as much as possible while taking, various levels of risk that's appropriate for them. So I have a little presentation that I will walk you guys through that hopefully explains a little bit more about what I do. It can be a little bit of a confusing field. So now I'm going to share the little presentation that I put together. So hopefully you can see that now. If I look at our first slide here, so who do we help? I kind of just mentioned it. Asset managers manage money, not just for millionaires, like some people, mistakenly think. It's governments, schools, universities, retirement funds, insurance companies, and then individuals like us. So pretty much everyone. And why we need to invest. So this is, I think, pretty important. It's basically the purchasing power of money declines over time if it's just sitting in a bank account or under a mattress. So we invest to keep up with something called inflation, where every year prices continue to rise. We're seeing that really more recently really start to accelerate in recent years, especially this past year. But I just put a basket of a few different key items in, that we all have to purchase or generally purchase during our lifetime. And you can see in this chart here, when you go back to 1970, so a long time ago, and then we look at it every 10 years up until today, you can see how the prices rise with inflation over time. So a new home in 1970 was $26,000. It's grown to hundreds of thousands of dollars. Today, you're now at, whoops, sorry about that. We're at well over $400,000 for a new home. A new car that was $3,000 in 1970 is now, climbing into the 40s, thousands of dollars. So same thing with a gallon of gas, bread, and pretty much any other item you look at over the past 10, 20, 30, 40, 50 years. So that's really important for us to make sure that our customers, individuals, and whoever else might be investing with us is maintaining that purchasing power, so that as the years go by, their hard-earned money and saved money is not just sitting idle, but it's actually growing, so that they can use that, one, to keep up with inflation, hopefully beat it, and two, the other point that I've got listed here is just increasing wealth. So eventually people would like to retire, and just saving alone doesn't make that easy. It's a combination of saving and then also investing that money to grow it into larger sizes. So common types of investments, you guys probably have heard of or know more about stocks. So you can see the definition there. It's a security, that signifies ownership in a company, where you own a portion of that company in the form of a share. It's a higher risk, but higher return investment. The other world of investing, common type of investment, and this is what I specifically do and spend most of my time on, is bonds. So that's a debt instrument where we lend money to a company, could be the government as well, and they borrow that money for a certain period of time, at a predetermined interest rate, and we collect that interest, and then they repay the debt after the stated maturity, and we get our full principal amount of debt that was lent back. So they tend to be lower risk, lower return. And again, I specifically invest in corporate bonds. So everyday companies that that you are probably familiar with. Companies like Verizon, Target, Walmart, Amazon. Those are the companies that I'm looking at and providing corporate bonds to. And my team is building a portfolio of those various corporate bonds to build a well-diversified mutual fund that we then provide to our customers and clients so that they can have a well-rounded, sort of diversified basket of companies. And we can talk about that in a couple minutes, why that's important. So what it means to own a stock, you're basically taking ownership in a company. You can buy, to make it simple, one share of a company that has 100 shares outstanding. If you do the math, which you'll find a lot of finance and investing is math, you would own 1/100th of that company, or 1% of the company. So there's a lot of things that can move a stock price up or down, and it's important to know that as someone that's going to invest. So there's what I would call company or industry specific drivers of a stock price. So it can be any news specific to the company or the industry you're investing in. You can reduce that by diversifying. So rather than just putting all of your money into one company, say Tesla, which is a popular one right now, you would buy a basket of several companies. And if Tesla were to come under heavy pressure and sell off significantly, well, you didn't lose almost all of your money. You've allocated a small percentage of it to just one company, and thus reducing your overall risk. There's also market or non-company specific drivers of a stock price. So that's generally news that impacts the entire market. So there's what we call macroeconomic factors that can move that up or down. So let's just look at a quick example. Under Armour is a pretty popular apparel company you guys probably know. So company or industry specific drivers, so things that can move the stock price up. So if they had a really good sales quarter in the most recent 3 months, that came in higher than what investors like myself were forecasting, then the stock price usually would go up. Or retail sales data for the industry is released last month, and it shows very strong apparel demand. That's likely to move their stock up. On the flip side, something that could push the prices down on Under Armour stock, say a new major competitor enters the athletic clothing market and is doing a great job taking market share, that would push the stock price down. Or, and we've been seeing a lot of this recently, say there's issues within factories, within Under Armour's factories, that's keeping it from, preventing it from meeting order demand. So we've seen a lot of that happening where either factories aren't able to run at full capacity because of COVID, or there's challenges getting enough product into the US from overseas with shipping and distribution issues. So that could be something that pushes the stock price down. Another example would be input costs rising. So for them, cotton would be a big cost, and seeing that rise significantly and unexpectedly would push their stock price down. So a common theme here is expectations. It's not so much just the numbers, but what the investors or the marketplace was expecting versus what actually happened. Then we talked about some non-company specific drivers of a stock price. So these would be things that can affect the whole market. GDP, which is a measure of our entire economy growth, is higher than expected, that would likely push all stock, or at least many stock prices up, including Under Armour. Interest rates being lowered, which makes borrowing more affordable. Again, that would likely push all stock prices up. Something that we're experiencing right now is inflation on the potential negative side. So a rapid rise of prices, more than the average that we get in a given year. That's something that can push stock prices down across the entire market. Or a natural disaster that hits an entire country and creates a severe blow to the economy. That's another example of something that would push not just Under Armour's stock price down, but the whole market down. Or you guys probably aren't too familiar with this, but there was a pretty big financial crisis in 2008 that put the banks under a lot of strain and really hurt the economy, pushed it into a deep recession, which is a pretty severe decline in the economy, in jobs, in unemployment increases. So that put a lot of pressure on the entire stock market. And again, Under Armour would fall alongside of the entire market. So building a stock portfolio, I talked about diversification. If you guys look at these 3 example portfolios here, you can take a minute and guess which one you think is the most diversified. And if you ruled out portfolio 2 right away, that's good for you, because 4 companies is a pretty small number to own in a portfolio. It's not, in terms of risk, it's not very well diversified. So if anything happened to one of these 4 companies, your portfolio is going to come under a lot of pressure. Now, the other 2, portfolio 1 and 3, it's a little bit tricky because they have the same number of companies in both. But the answer would be portfolio 3. And the reason is, if you look at portfolio 1, it's an entire basket of technology stocks. So that's not going to be as well diversified as a portfolio of companies across several different industries. You notice there's Walmart in retail, there's Bank of America in financials or banking, there's Verizon in telecommunications, we have Apple in technology, McDonald's in restaurant, Exxon in energy. So it crosses over a number of different industries versus this first portfolio, which looks super exciting, but it's entirely technology. So if that industry comes under pressure, that whole basket of stocks is going to sell off at a more rapid pace. So there's some really cool analytical tools that I use and that you guys could start to pay attention to. One is sales. So that just is another way of saying how much the company is, how much of their goods or services the company is selling. Are those going higher or lower? When we typically like to compare things from the prior year. So are they, if you were to look at a graph, is it going up each year or is it going down? And what's driving that growth? Is it because they're doing well, or is it because they're buying a bunch of businesses which can artificially increase their sales? It's not what we would call that nice organic growth that's that the company is generating on its own. And then we look at profits. So profits is basically what's left over after all of your costs to either make your product or to perform your service. So are they actually generating a profit? Sales could be growing really nicely, but if the costs are growing at a higher pace than their sales, then they're actually going to be showing declining profits, which is not that great from an investment perspective for an investor. Then we can get a little more complicated and we can look at things like price to earnings ratio. So you can look at a company's stock price, which would be the numerator, and you could divide that by their earnings per share. And these are all things you can look up on the internet, Yahoo Finance, Google Finance. I'm sure there's a number of other resources, but you can look at a price to earnings ratio. Again, it's just a fraction of numerator stock price over the denominator, their earnings per share. Typically, a lower ratio means the company is more undervalued. And it's just a helpful tool to compare companies. So I can look at several different companies that are in a similar industry and compare the price to earnings ratio and try to identify companies that look cheaper than others and that might have more room to grow in price. Debt, I spend a lot of time looking at debt because I'm a bond investor, a fixed income investor. So I always like to look at the balance sheet, how much debt they have, because they're paying interest on that debt. Can they meet that obligation? If a company is unable to make those interest payments, then they basically have to go into something called a restructuring or a bankruptcy, where their stock can end up going to zero, and they basically have to stop operating or have to restructure. So paying close attention to how much debt a company has is very important, especially in my role. You can look into the industry for the company that you might want to invest in. Is it a growing industry? Is it a declining industry? We can look at both the short term and the long term, and the competitive environment. So how fierce is the competition? How many companies operate in that industry? Is it one or two players, which is a pretty beneficial environment to operate in? Or there are 10, 15 companies competing, where it can be a lot tougher to make a good profit. So that's the end of the slideshow. And I don't want to ramble on too long, but I would say what got me really interested in this field, I love math. I've been a math nerd since I was a young kid, and I think math is a really important part of becoming a successful investor, especially doing fixed income or bond investing. There's a lot of numbers to look at, a lot of calculations to do. I also really just love the idea or the concept of investing. So taking $50 or $100 and seeing if I could grow that, again, even when I was younger, trying to find ways to grow that so that it wasn't just sitting idle. So I would say my advice to any of you that are interested in finance, investing in that world, I would say try to get involved in some of the extracurriculars, either at your school or maybe outside of your school, that offers investment clubs or finance clubs. Usually in high school, maybe even middle school, and definitely in college, there's investment clubs that either pretend invest, so they're not taking real money, but you can build a pretend portfolio of $1,000, $100,000, whatever amount, and see if you can grow that, see what you can turn that into. In college, they usually even give some level of real money called, they'll give you a portion of the endowment money that the school has, and you can join a team there that allows you to invest that for the college and see what kind of returns you can get for them. I would encourage you to read a lot on markets. So there's so many publications out there, the Wall Street Journal, Bloomberg, Barron's, and plenty more free ones, Yahoo Finance, Google Finance. There's plenty of free resources, but just read anything you can about the markets. That's the best way to learn. And then I would say, even if you don't join an investment club, build your own pretend portfolio, or you could even put a real small amount of money into one. And there's a lot of resources and tools out there that will allow you to do that. Again, Yahoo Finance and Google Finance, you can do that for free, and you can just go through and build your own little basket of companies, stocks, and track it and see how it does. Again, with pretend money or a small amount of real money, and to see how you like it, see how much you enjoy it. If you really start to like it and want to learn more, that's probably a good indication that this could be a fun and cool career for you. So I'm trying to think if there's anything else. I think I'll leave it there. I would say the best thing you can do if this is a field that interests you is again start investing for fun on your own, and pay attention to math, because that's a big part of what I do. I use it every day. Okay, thanks everyone. Bye.